morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, today we're taking a look at financial results from one of the perhaps maligned sectors of the Trinidad and Tobago Stock Exchange, well, across both sectors, but we're speaking about energy sector related stocks, and we're going to focus a bit on the financial results or the delayed financial results of Trinidad and Tobago NGL or TTNGL, as well as National Enterprises Limited or NEL, who both have significant exposure to the energy sector through various sources. Let's take a look at how both of those companies would have performed and what investors might expect in the coming months ahead. So let's take a look firstly at TTNGL, and for that fiscal year, and we have both the full fiscal year for 2023 and the first quarter. For the fiscal year ended December 2023, TTNGL reported a loss per share of $3.54, which is an increase in the loss, or a more pronounced loss than the $2.56 loss per share reported in that prior comparable period of fiscal 2022. Now, total income or mostly operating results would have actually declined about 83% from $168.3 million to just about $28.2 million. That 83.2% decline really attributable to more difficult operating conditions, including lower production of NGL liquids or raw liquids coming into the processing plant, as well as higher feedstock costs and lower product prices, which would have occurred during that fiscal 2023, as well as some one-off operating expenses. However, the main talking point for investors would have been a second consecutive impairment loss of around $573 odd million TT equivalent, which follows a $562 million impairment loss in fiscal 2022. So cumulatively over those 2 years, over $1 billion, close to $1.1 billion, in fact, in impairment losses. And these are non-cash losses arising from the valuation model used to value PPGPL's assets. PPGPL, of course, being the underlying and sole investee company of TTNGL, which is a holding company. Ultimately, that resulted in a loss after taxation of $547.7 million, which was significantly more than the $396.6 million loss experienced in fiscal 2022. So on a fiscal 2023 or full year basis, TTNGL would have continued to struggle, again, on the heels of those impairment losses, but also much more challenging operating environments. When we move to the first quarter results, which were also published quite close to its delayed full year 2023 results, we can see that there is a slightly brighter picture. Earnings per share for that first quarter of 2024 was 20 cents per share, which was 122% increase from the 9 cents reported in the prior comparable period for TTNGL. That share of profit from its joint venture would have increased 107% odd from 14.9 odd million to just over to almost $31 million, with profit after taxes ultimately increasing that 109% from 14.6 million to 30.5 million. So a doubling of profits for TTNGL in that first quarter. And this would have been attributed, according to the group, to improving product prices, as well as improving the natural gas liquids content coming through to its processing plants, in addition to much reduced feed costs. In fact, feed costs would have reduced in terms of cost by about 23% if I'm not mistaken. And this was reported at its most recent broker meeting on last Friday. Now, in terms of those impairments and what it's been doing to the stock, but to the stock's book value per share, well, it's very clear to see that from fiscal 2021 going into fiscal 2023, those consecutive $570 odd million impairment losses would have knocked off just about $3.50 to $4 per share in terms of the book value of TTNGL, falling from $14.37 in that green column of fiscal 2021 to $10.92 in fiscal 22, now to $7.36 in fiscal 2023. That has led to some significant, and these impairment losses has led to a significant erosion in investor confidence, of course. And we can see that from a market to book value of around 1.5 times, or price to book value equivalently, that price to book value has fallen to about, or ratio has fallen to about 9.9 times, suggesting that investors are trading or have less confidence in the stock and are trading it at much closer to book value than it was trading at in prior comparable periods. Now, one of the other major factors affecting investor confidence in TTNGL is that it has traditionally been viewed as a dividend stock. And since fiscal 2023, there has been a palpable absence of dividends. Of course, TTNGL trying to ensure that it remains consistent with its regulations in terms of being able or legally being able obligated to pay dividends to investors, and in terms of the legal requirements at this particular point in time. While there are cash resources to pay a dividend of around 80 odd cents per share, the TTNGL is unable to do so given some of the legal restrictions that are currently applicable. Of course, the group would have asserted that it is looking at all possible options of getting a dividend into the hands of shareholders, but there have been no concrete solutions announced just yet to the broader market. So when we look at the dividend history of TTNGL, we can see that it has been quite a rocky ride over the past couple of fiscal years, certainly from fiscal 2018, when the last expected dividend of $1.50 would have fallen to 75 cents, going all the way down to 35 cents, the last interim dividend paid in fiscal 2022. But it has really been absent, a drought of dividends since that period. So no dividends declared throughout the first, the entire fiscal 2023 and the first quarter of 2024. So at a price of $6.99 per share, TTNGL, with that negative earnings, is not tradable, doesn't have a P and a positive P ratio, and does not offer a dividend yield at this particular point in time. However, it is trading at just around its book value per share. So with increasing energy commodity prices in mind, although a very dynamic environment in the energy space continues to persist, with higher profits from its underlying asset, its continued expansion and international expansion and diversification, but of course that palpable absence of dividends, which would erode investor confidence in the near term. Bourse is adjusting its rating on TTNGL from an overweight to a market weight for the time being. Turning very quickly to NEL, well, for that half-year period ended March 2024, the group recorded a loss per share of 22 cents compared to an earnings per share figure of 75 cents per share in the prior comparable period. Now, dividend income also fell for NEL. Fell for NEL for about 72% from 377 million to just about 107 million. Operating profits fell that 71% from 381 million to 110 million. Of course, that impairment change, a change in the fair value of assets, would have really weighed on NEL as well, falling from a $69 million gain in the fiscal half of 2023 to a $241 million loss, or in change in fair value, again, a non-cash impairment loss, or a non-cash loss in the first half of 2024. Overall, comprehensive losses for the period being in at just about $153 million versus a comprehensive gain of 447 odd million in the prior comparable period. Now, when we take a look at some of the major production and pricing trends in the overall energy space, we can see that natural gas production domestically has continued to languish at around that 2.6 billion standard cubic feet per day. Of course, as mentioned at the mid-year review, natural gas prices have continued to be under pressure, with Henry Hub prices in particular falling from an average of $4.44 over the prior comparable period of October to February 2023 to $2.62 for October to February 2024. Natural gas liquids, slight improvement over the comparable period from 2.1 to 2.45 million barrels, with prices continuing to be relatively stable, $1.15 versus 1.23 cents per gallon on average. Ammonia prices falling from $938 per metric ton to just about $497 per metric ton, with production also falling from 1.9 to 1.56 million over the comparable periods, and LNG production relatively stable, 7.25 million cubic meters versus 7.19 million cubic meters over the comparable period. The book value per share of NEL, like TTNGL, has struggled, particularly with those changes to fair value valuations, with that book value per share falling from $7.10 to $5, just around $5 per share. But the book value, or the price to book, in fact, has traded relatively consistent at around that 0.6 to 0.7 time level, suggesting that investors are continuing to value the share relatively consistently over time, notwithstanding the volatility in markets. So at a price of $3.47 per share, NEL, again, with a negative PE ratio compared to the sector average, excuse me, of 12.8 times, with a dividend yield of 11.2%, certainly some of that trailing from a very good dividend period in the prior comparable year, trailing into the new fiscal year, compared to the sector average of 5%. But with those lower but somewhat recovering energy prices in mind, domestic energy production recovery certainly in question, given where that energy production recovery is expected to come from. But that attractive dividend yield, again, taking that with a pinch of salt, given that it is pretty much a trailing attractive dividend yield. Bourse is maintaining its market weight ratio on NEL for the time being. Well, that's it for this week's edition. For more information, you can give us a call at 226-8773 or 2-Bourse. Email us at invest@boursefinancial.com. And of course, you can check out all our research, which is absolutely free on our website at bourseinvestment.com. And of course, you can catch this article for more insights in the business section of the Trinidad and Tobago Guardian newspaper today. So until we meet again, have a safe investing week, safe and prosperous investing week, and we'll see you next time on the Bourse Report.